You are listening to Mining Stock Education, where you'll learn from the top leaders in the natural resource sector and uncover quality mining investment opportunities.
The gold price can run to $3,000 pretty quickly. I mean, conservatively, I would say the gold price could run to $3,000 by 2024. But as extremely bullish as that coupled handle formation is, we could see $3,000 an ounce by next year.
Welcome back. I'm Bill Powers, and this is Mining Stock Education. Joining me is David Erfle of Junior Miner Junkie with a Y.com. Dave, thanks for coming back onto the show. And gold is knocking on the door of 1900 as you and I chat. So do you think we'll break through that and that will become support, or are we going to see multiple retests of 1900 before we eventually break through?
Well, that's a great question, Bill. And thanks again for having me on. Always great to talk to you. Yeah, it's a lot of the reason for the gold price. It's nice to see the gold price at 1900, but a lot of the reason behind it hitting 1900, which is strong overhead resistance, is it's a war premium of what's going on in Russia and Ukraine. But what's nice to see right now is, even though the gold price is short-term extreme overbought, it's attempting to consolidate above 1880 here. As you've alluded to previously, as we've seen many times previously, we've had several false breakouts during this 18-month consolidation, as well as several false breakdowns. The interesting thing to see on the breakdowns is they're bought immediately, meaning there's intraday reversals and there's bullish hammers intraday each time the gold price got down to 1675. But on the flip side of that, when the gold price attempts to break out higher, it stays above where its downtrend line and tries to consolidate a few days, then gives up the ghost and comes back down into that consolidation at a symmetrical triangle. But we've really got a lot of the wind at our sails here this time, because we've also got the Federal Reserve on the verge of making a major monetary policy shift while inflation continues to rage out of control. So it's kind of a perfect storm for gold right now, but is yet to be a perfect storm for gold juniors. We started to see the major bellwethers, Newmont and Goldcorp, get some bids out of this. So see some sector rotation coming out, because what I'm really encouraged to see is the mining sector and gold now outperforming the stock market. That's what we've been waiting for so long. We've watched the stock market continue to climb a wall of worry higher and higher, while shorts continue to get pounded, having to cover. It goes higher. And in the meantime, the gold price has been super boring for so long. It's traded sideways within $100 range for almost a year, while everybody and his brother's been throwing away gold stocks, and especially juniors, which has created an incredible opportunity here. But it remains to be seen if the gold price will start to build a floor at 1900. I really think that the market is starting to believe that a floor at 1800 is being put into place. Yet, although the juniors aren't recognizing it, the majors and now the royalty plays are. So it's really going to be interesting to see, as we have 4 weeks now yet until the Federal Reserve begins to raise interest rates, which is completely priced into the market now. But the war premium is basically keeping the gold price bid higher, despite the fact that yields have been rising. So, with Russia likely to go into Ukraine any day now, you've also got China possibly going into Taiwan at the same time. You've Putin and Xi were over there at the Beijing Waldorf during the Olympics, talking strategies and making deals. So they could be doing this simultaneously, and which would really put a monkey wrench into the marketplace and really ratchet up the volatility in the gold price. So even though the gold price is short-term overbought, if God forbid war does break out, And the gold price could run to $2,000 really quickly. I would really, to tell you the truth, I would not like to see that, because that would come off rapidly, I believe, as $2,000 is very, very strong resistance. And if the gold price does ramp up to $2,000 so quickly without correcting this move thus far, I think it would come off pretty quickly. But we want to see the gold price go up because of macroeconomic reasons, and all those reasons are in place for the gold price to go up higher. This reminds me of what took place during the 1970s bull market, when the gold price ran from about $120 to $850 in a short period of time, as stagflation was in the system. Inflation was raging out of control. The Federal Reserve started to hike rates at from 4.75 to 20%. By January of 1980, and the gold price was zooming higher. But what took the gold price to a blow-off parabolic high, was Russia invading Afghanistan simultaneously while we had the Iran hostage crisis going on, and that was what took the gold price to a parabolic high. And it took 20 years for that move to consolidate. I don't see that happening this time, but I'm just saying this is what could happen when you have a war premium in the gold price. It could come off really quickly.
So Dave, you're not a trader, and let's make that clear. You don't offer a trading service. However, if you get that parabolic war premium, such as you just described, might you trim some of your positions knowing you could probably buy the same companies back in the not too distant future?
Well, it's a totally different scenario as far as when the gold price blew off to $850 back in January of 1980, to where if gold price zooms up to $2,000 here during this move. Back then, gold was at the gold mining complex was at toward the end of a major bull market. Right now, a lot of these juniors, you can't give them away. I mean, these investors are throwing them away with reckless abandon. I've seen the opportunities just get more and more attractive in these stocks. So, if that took place, you probably see some of the recent gains come off of sharply of the recent companies that have been a beneficiary of some mining investments like Barrick and Newmont, and now Royal Gold and Franco-Nevada, the two bellwether royalty plays. Sure, you're going to see moves come off there, but this bull market hasn't even really started yet in the mining complex. I mean, if you take a step back and you look at the incredibly bullish cup and handle formation, 12-year cup and handle formation is being formed in the gold price. It's extremely. I mean, people just don't really understand how extremely bullish a cup and handle formation can be in a major market, because there's really not that many examples of it. So once the gold price has a monthly close above 1,900, that will technically confirm that technically confirm the bottom is in this consolidation. But once we have a monthly close above 2,100, then that would technically confirm the cup and handle formation being in place. And the gold price can run to $3,000 pretty quickly. I mean, conservatively, I would say the gold price could run to $3,000 by 2024. But as extremely bullish as that cup and handle formation is, we could see $3,000 an ounce by next year. I'm not predicting that, but I'm just saying that's a possibility. And these mining stocks that are ridiculously cheap right now in relation to the gold price could really go a lot higher, because once you have $1,900 closed above on a monthly basis, the professionals start to come in and momentum traders start to come in. That's a flash signal that, hey, this sector is about to break out and take off. And this mining sector is tiny. mean, if you take the entire market cap of the mining sector, it's not even $800 billion. So once this takes place, I expect to see quite a lot of capital start to finally come into this sector.
So Dave, as you know, when gold sells off, the explorers are the first ones to get sold. But when gold's going to go on a run, you mentioned the Newmonts, the Barricks, the Franco-Nevadas, they begin to perk up. Somewhere down the road, these little gold juniors perk up, and then they begin to fly. So I guess, are you looking at a lot of these junior explorers that are cashed up right now if you think there's going to be a powerful move in gold? Because you get a 200% move with no discovery in these stocks if gold moves.
Yeah, I've since October, I've been accumulating developer explorers. I've been staying away from the higher risk drill plays, because let's face it, when you see all this value on the table in companies that have already proved up multi-million ounce resources, and they're on sale, and they're cashed up, and they're located in top tier jurisdictions, and the management team has got access to capital, and they've done the right things. They raised money at the right times when their share price was high. And when you see that much value on the table, there's really no need to take a lot of risk in companies that have yet to make a discovery or define a resource. So although I do have exposure to some companies like that, there's a company that I was fortunate enough to get in early, and it went up several times, and I was able to take my original investment off the table. So it's basically a free ride. So I'm keeping those shares. And plus I have warrants in other companies that are early stage. I've sold the shares and I still hold the risk-free warrants. And so I do have exposure to companies like that. But I really like the developer explorers right now that are de-risking these high margin multi-million ounce assets. Now, I know probably the next question you might be asking me is the CapEx has been going up on a lot of these companies. And the market has been punishing a few where the CapEx went up considerably, like IM Gold and Argonaut. So you do have to be aware of that. But
and when do they become good buys again, Dave? Is it $2,500 gold? Is it $2,100 gold?
Well, that's the thing. It all depends on the margin on the project. Let's say it's a high margin project at 1,600 gold. But it's a higher, of course, it's a higher margin project at 1,800 gold. If it's at 1,800 gold and they've got an IRR above 35, 40, and the CapEx is still reasonably decent. Once the market begins to price in a solid $1,800 floor, which I don't think will happen until we get that $1,900 a month close above 1,900, right? I think those will be. I mean, they're cheap right now, but I don't think they'll be cheap very long once that takes place. And what I'm looking for is as a sign that the bottom is in for the higher risk juniors. And I mean higher risk juniors are junior companies that consume capital. They don't throw it off like producers or royalty plays. I'm looking at a close above 47 in the GDXJ, and it's still quite a ways from 47. The close above 35 in the GDX is the signal I'm looking for that there's a bottom in the mining sector. Close above 47 in the GDXJ would be a technical signal that the bottom has been put in place in the junior sector. But the higher risk juniors, the ones we've been talking about here, those are the last ones to start moving up. The last ones in the food chain are those drill plays, those higher risk drill plays that have yet to define a resource. So basically, to sum up, right now we're seeing majors getting a lot of bids as the gold price has reached 1,900. We've seen royalty plays now start to get bids along with other miners. Then we're going to see mid-tier miners get more bids. Then there's the developer explorers that are de-risking high margin multi-million ounce asset projects. And then finally, that's at the end is when the drill plays, the explorers start to go up higher. But I would still just be very conscious of how much cash all these companies have. Even if you're a developer explorer and you are in that category of de-risking a high margin project, if you don't have a lot of cash, the market's going to sense that, and they're going to sense that dilution. So the stock is probably going to lag the sector until they raise capital.
Dave, what's your perspective and approach when a management team makes you a lot of money, so you're happy with them, and maybe they make you money a couple times, then the third deal comes along, you invest based on your success with the previous two, and the management team thoroughly disappoints. Do you give them another chance, or could you just talk through your take on this? And the reason I'm asking you this is a lot of times I see comments where somebody invests in a company, they don't make money, or they don't make money within the time frame they give management a chance, and then they just immediately trash management. Now, I'm not here to stick up for bad management, but oftentimes, I don't think they're being fair.
No, that's a great question. I've been caught up in this before. I always like to invest in serially successful management teams. That's a big box that I like to have checked before I take an investment in a company. And there has been management teams that I've invested in that have made me quite a bit of money more than once. But there's also been it can also be a detriment. If you put too much faith in their past successes, it might cloud your vision of the red flags that are that may be in the project that they're de-risking or the company they're attempting to build at present. And that has happened to me before. I mean, you still have to make sure that they tick all the other boxes, share structure, retail float, ownership. Those things are very important, as well as the management team. What
ratio be of retail and institution in the share structure? Like, say, for a junior explorer or developer, is there a point where there could be too many institutions in to where you don't like the illiquidity? And is there a point where, at what point percentage wise, is there too much retail in a stock?
Yeah, it's a fine line. I mean, if there's a retail of less than 20%, then that's kind of a concern. But and on the flip side of that, if there's retail of over 50%, then that can start to be a concern as well. I like to 50 to 60%, 50 to 60%, I'd say. If I see retail float of over 60%, not a lot of institutional ownership, that's a bit of a concern.
And is that because you don't think there's sticky hands with the shares? Is that
exactly
the primary concern?
I mean, because that's what you found out. That's what a lot of people have found out during this correction. Because when you have a long consolidation in this sector, and this has been a considerably long consolidation of 18 months. Toward the end of it, the retail sector really starts to give up the ghost. So if you have a high retail float of 65, 70, 75%, that stock is going to get destroyed, no matter how good it looks on paper, no matter how good the management team is. So these things you have to keep an eye on for sure. There's a myriad of other things you need to look for, but that is a major concern, is too high of a retail float or too low of a retail.
Dave, what role does, in your due diligence process, when you're assessing management, how much weight do you put on assessing the board members and their contribution? And I want to share with you something I read recently, which I really like. The person said that oftentimes in this sector, the directors can make the least risky decisions for themselves, their personal reputations, and their options or their holdings in the company, rather than trying to say, how can I maximize value for all of the shareholders? So I thought that was insightful. How do you assess board members?
Yeah, absolutely. That's one of the big things that I look for. One of the first things I ask when I'm evaluating a company is I ask them, how many shares do you own, and what did you pay for your shares? That also goes for the directors.
And Dave, you don't do a write-up until you get that info. I know from communicating with you, like you won't do your report. You're like, I want to issue my report, but I'm waiting to hear back what he paid for his shares.
Yes, absolutely. Because, I operate my business the same way. Since that is a big pet peeve of mine, management not owning enough shares to be aligned with shareholders, I do the same thing in my business. I'm not going to recommend a company that I own that I don't own shares in. I'm aligned with my shareholders as junior management team. I'm aligned with my subscribers as junior management team should be aligned with their shareholders. So that is a big one for me. It's like I like the we're all in this together approach. We all share the same goal, right? I have a goal of making money with your company. If you have a goal of just supporting your lifestyle and not making your shareholders money, then I'm not going to invest in you.
Excellent. JuniorMinerJunkie.com with a Y. Anything new listeners should find there, Dave?
Oh, there's lots new. I work tirelessly to keep my subscribers up to date on what's going on, not only in the sector, but economically, what's happening with the Federal Reserve and what they're talking about, what's happening in other companies, other countries, and what they're doing economically, what's happening in the sector as far as news releases are concerned, what's bullish, what's bearish, what's going on with each company individually. I give a technical analysis of each company each week, update that. So there's always something new, and I basically try to keep my weekly newsletter as like a one-stop newsletter where you don't really have to keep on top of the market until you look at my newsletter, which keeps you on top of the market for you.
And it takes at least an hour to read when you do send it out. It goes down and down. The email keeps going down. It's like, click here to access more. I keep clicking. So it's very thorough. Go check out Dave's website, JuniorMinerJunkie.com, junkie with a Y. If you're not on his email list, you can sign up for free. He will send you his weekly Kitco commentary. Dave, thanks for the monthly check-in today.
Always a pleasure, and I always look forward to it. And best of luck to everybody out there. This is a great time to be in this sector. When everybody is very bearish, despite the fact that the gold price is knocking on the door of a breakout, and there's still a lot of value out there. It's a great time. You've got a window of opportunity to take your time, get in the right companies, and hold for a long term.